In this video, we're going to explore two categories of income: capital income and revenue income. First, what is income? Well, income is the money that is coming into a business from its various activities, such as selling products, investments, or even taking out loans. Income is crucial because it helps a business cover its expenses, make investments, and ultimately determines its profitability. This money that is coming into the business, which is called income, can be categorized in two main ways: capital income and revenue income. So let's first look at what capital income is. Capital income is money coming into the business from sources other than regular business operations. It often includes loans, mortgages, or the selling of shares. For instance, if a bakery takes out a loan to expand and improve the store, the loan amount is considered capital income. Think of it as the fuel that powers the engine of your business, allowing you to get it up and running or expand. Here are some examples of capital income a business may have. Loans. When you secure a loan, you're acquiring funds from an external source, often in the hopes of propelling your business forward. These loans can come from traditional banks, credit unions, or even online lenders. They can serve various purposes, such as funding startup costs, expanding operations, purchasing inventory, or investing in equipment. Loans typically come with interest rates and specified repayment terms, which can be short-term or long-term. It's crucial to choose the right type of loan that aligns with your business's goals and financial capacity. Mortgages. For many businesses, owning property is a key milestone. Commercial mortgages provide the means to acquire real estate, whether it's an office building, a retail space, or a manufacturing facility. Similar to personal mortgages, commercial mortgages allow businesses to spread the cost of a property over time, making large investments more manageable. The property itself often serves as collateral, providing security for the lender, which could be a bank. It's a strategic way to gain control over your workspace and build equity over time. Shares. Shares represent ownership in a company and are commonly issued by corporations to raise capital. When you sell shares, you're inviting investors to become shareholders in your business. These shareholders invest their capital in exchange for a proportion of ownership and potentially a share of profits through dividends. Shares can be issued privately or publicly, with public offerings being traded on the stock exchanges. For startups and established companies alike, issuing shares can be a powerful way to fund growth and expand operations. Owner's capital. Owner's capital represents the owner's personal investment in the business, as it's them putting their own money into the business. This often happens to fund the startup of the venture, as it can help fund initial expenses or provide working capital. Owner's capital demonstrates a strong commitment to the business's success and can serve as a source of funding when traditional loans or investments are not readily available. It's a way for entrepreneurs to take full financial responsibility for their venture and reap the rewards of its success. Debentures. Debentures are a form of debt instrument issued by a company to raise capital. They are essentially bonds, typically with a fixed rate, that companies sell to investors. When you purchase a debenture, you're lending money to the company, and in return, the company agrees to pay you the principal amount along with interest at specific intervals. They are a way for businesses to access funding without giving up ownership or control. So, they're the different types of capital income a business could have. Now, let's connect the theory to reality. Apple is one of the world's most iconic tech giants, and has used shares to raise capital for decades. By issuing shares to the public, they have attracted a vast pool of investors who believe in the company's innovation and growth potential. These shareholders not only provide the financial backing needed for research, development, and expansion, but also share in the company's success through stock price appreciation and potential dividends. Apple's ability to harness the power of shares as a source of capital income has been instrumental in its journey to becoming a $1 trillion company. Now it's time to look at revenue income. While capital income lays the foundation, Revenue income is the steady stream of earnings that keeps the business engine running smoothly. It's the income generated from the core operations and activities of the company, primarily the money coming into the business from the selling of its products or services. Here are some key examples of revenue income. Sales revenue. This is the money a business earns from selling its products or services to customers. For example, when you buy a new iPhone, the money you pay is part of Apple's sales revenue. It's the core income source for most businesses, and effective sales strategies are essential for maximizing this revenue stream. Rent received. Some businesses own property which they then rent out. Like office spaces, rent received is the income they earn from leasing these properties to others. Think of it as the money your landlord gets from you if you're renting a home. It can be a steady source of income, helping to cover property expenses and generate a profit. Commission received. Many businesses, especially those in property, insurance, or brokerage, earn income through commissions. They get paid for facilitating transactions or providing services on behalf of clients. For instance, a business that sells real estate may earn commissions when they successfully sell a house. Commission income is likely tied to the number and value of transactions they handle. Interest received. Interest income comes from investments a business makes with its extra cash. It's like the interest you earn from your savings account, but on a much larger scale. For example, a bank earns interest income from the loans it gives to customers or from investments in things like bonds. This passive income stream contributes to a company's overall financial health. Finally, discount received. Surprisingly, businesses can also make money from discounts. This happens when suppliers or vendors offer discounts or rebates for prompt payment or bulk purchases. If a business pays a supplier early and receives a discount for doing so, that discount amount becomes revenue income. It's a smart way for businesses to optimize their cash flow and reduce costs. Now we know the types of revenue income, let's look at an example of a business that has smashed it in terms of revenue income. In 2022, McDonald's, the global fast food giant, generated just over $23 billion in sales revenue from its vast network of restaurants worldwide. Every burger, every Happy Meal, and every cup of coffee contributes to their sales revenue. By having such a massive income from sales revenue, helps McDonald's not only cover operating expenses, but also drives expansion, innovation, and continuous growth. It's a prime example of how consistent and robust sales can bring in obscene amounts of money that can be used to operate and expand a business.